friends. For our first course session on macro and markets themed COVID, Convergence and Correlations, let's invite our chair today, Ridzuan, Director of Research, Khazanah, and he'll be joined by Dr. Andrew Ang, Head of Factor Investing Strategies, BlackRock, Joyce Chang, Chair of Global Research, JP Morgan, and Nadia Jalil, Regional Head, Group Economics and Market Analysis, CIMB Group. Please welcome our panel speakers. Over to you, Ritz.
Thank you for joining us at the first panel session of the 2021 Khazanah Megatrends Forum. Today's macro market session is titled COVID, Convergence, Correlations. Joining us today, Joyce Chang, Chair of Global Research at JP Morgan, Andrew Ang, Head of Factor-Based Strategies at BlackRock, and Nadia Jalil, Regional Head of Economics and Analytics at CIMB. Now, going back to the title of today's session, there's been a lot of COVID, but very little convergence. Nadia, it's a very difficult time to be a macroeconomist. Globally, countries are all over the place with respect to where they are in the recovery cycle. China has gone way beyond the recovery phase, and it's now actually starting to slow down. The US is at peak growth thanks to all those QE-funded stimulus checks. Other Asian countries are a mixed bag, depending on how exposed they are to the semiconductor cycle or how free they are from COVID mobility restrictions. Nadia, what on earth is going on?
Thanks, Ritz. Thanks very much. And thanks very much for the invitation as well. What on earth is going on? I think if you speak to any macroeconomist today, they're going to say your guess is as good as mine. I think it's a pretty humbling time for all of us economists, given that all our crystal balls seem to have malfunctioned slightly, or we've got to make a lot of adjustments to all of our forecasts given the emergence not just of the pandemic, but all the other factors that come along with it, such as the supply chain disruptions on the trade side. The fact that it's really a new world that we're seeing. It's not just a new normal, and the jury's still out as whether that world is going to be a brave one or one that's going to be full of fear, right? So in terms of getting down to the hard numbers, you're right in the sense that we've got this multi-speed economic recovery and growth going on within the world itself. Whilst generally speaking, the global economy is definitely on track to achieve recovery, the composition of that growth and where that growth is coming from has shifted somewhat from the earlier assumptions that we had in the beginning, where we thought that the growth of developing countries that had earlier in the pandemic seemed to have controlled the pandemic in a more effective way than countries such as the US and even parts of Europe. And that's shifted now that we've seen with the emergence of the Delta variant. And of course, the delay in the vaccine deployment in most of the developed world. You've got nearly I guess it's about 60 to 80% of the adult population, at least in the developed world, being vaccinated, whilst you've got less than half of that in the developing world, and even less than that in lower income countries. So firstly, when it comes to COVID, I guess it's a fact of we can't be safe until everyone is safe. No one is safe until everyone is safe, right? And I don't know if countries around the world have actually internalized the fact, given that vaccine inequality is going on. So in that sense, yes, China is now moving on to rebalancing and structuring its economy, and that's going to impact the way how its trade partners, particularly those of us in ASEAN, as well as other developing countries, formulate our growth strategies and our recovery strategies, given that most of us have China as a major trade partner and a major source of export demand. Then you've got the US that, as you said, is at peak growth. And another factor that developing countries, or rather emerging markets, have to look out for is a normalization of interest rates. Once that happens, the runway for developing countries and emerging markets to actually access global liquidity is going to be pretty much shortened. And that's another headwind that we have to look out for. And again, we're still not out of the woods when it comes to COVID. I think we spoke earlier on, and you very optimistically mentioned that, what are we going to do next year when COVID is over? I don't think we're going to see the end of this pandemic. Already governments are talking about it being endemic. So moving forward, it really is a matter of how long or how resilient countries can be and how dedicated they are to restructuring and their economies, as well as, things like the way that our societies are organized in order to sustain that recovery.
Right, thanks. Joyce, you're on record as being relatively optimistic on global growth. You've mentioned in the past that we are late into this COVID cycle due to mass vaccination, and we're still at a very early stage of the economic growth cycle and the inventory replenishment cycle. Could you elaborate on that?
Well, I fully agree with Nadia that it is a multi-speed recovery. So let's just look at the different rates of growth in the world. So we have European growth in the third quarter of the year at 10%, double-digit growth. But we have China at slightly negative, not even at zero. And we have the US at 5% growth. Now, the second half of the year, we are looking at global growth at 5%, but with some very big differences. And we do think that tapering will begin by the Fed at the next meeting in November, that they will formally announce this as well. But 5% is a healthy number. And when we've looked at the differences between this crisis and past crisis in the United States, you have a very high household savings level and also much better corporate balance sheets than we've had during previous cycles. So we do have US growth at 3.7% next year. China, we have growing at north of 8% this year, but we think that will slow down to 5%. 5.2% next year. And I think the China slowdown is actually the biggest risk we see to the global growth outlook right now. Just looking at some of the back of the envelope numbers that we calculate, every 1 percentage point decline in China's growth is about half a percentage point off of global growth. And it's even more for many of the commodity exporting countries. Like Latin America, that correlation is practically 1-to-1. But I also think that, as much as Nadia said, there's also sort of a different view on how to address COVID. I mean, Asia has much more of a view that a single COVID case is a problem for everyone. Whereas I think that many of the Western developed market countries have really broken that link between mobility and COVID and are taking a different approach. So I don't think you're going to see something that is actually, that synchronized. But we still have, a growth number that is above trend. And I still think there is a lot of pent-up demand from consumers that will still come online. Now, I am not so sure that you're going to see the inventories and the supply chains revert back as quickly as we thought, because I do think that Asia is taking a different approach to the way that it is addressing COVID. But I think pent-up consumer demand is still very much a force that will be in play. I also think that in the corporate sector that you will continue to see the CapEx coming online as well. But we do have more concerns now with China, given the financial regulatory tightening that is underway. And I don't think that we've seen the end of this yet. You're going to continue to see, I think, some policy tightening measures coming out in certain sectors. You also have the Evergrande saga that's playing out right now as well. But 5% growth is, a very strong number. And I think one big difference from this COVID pandemic crisis is that, if we take a look at the United States as an example, after the global financial crisis in 2008, it took 38 quarters to close the output gap. And in this recession, we are looking at an output gap that's closing in about 6 quarters. But I think one of the characteristics of this crisis is that we're probably in for much more shorter and more volatile cycles. So I think it's still early in the cycle, but just as we've had some of the fastest downturns ever and the fastest rebounds ever, even though they're at different speeds, I do think that we are going to see that this crisis means shorter and more volatile cycles, partly because the inflation numbers really do point to a shorter and more volatile cycle than what we've seen. But a big difference is that at the household and corporate level in the US, so much deleveraging had occurred after the global financial crisis that those excesses hadn't had time to really build back up. So those sectors are much more healthy.
Thanks, Joyce. But surely financial markets have priced much of this recovery upside in, especially in developed markets, China A shares, India, all of which are between 20 to 40% higher today than pre-COVID. How do you play this? How do you understand the markets, right, Joyce?
Well, I do think that you're absolutely right that, if you just take a look at the U.S. equity market, as I said, these are much shorter and more volatile cycles. So, at the global financial crisis, it was about 14 months from peak to trough. It was 33 days from peak to trough for the U.S. equity market. And then 6 months, it was at a new record, which took several years after the global financial crisis. So I think the key thing that it's in the U.S. that has really been driving the equity market, though, has been the earnings. The earnings have come in very strongly, and we still think that business capex and corporate profits look to be in a very good place. I still think there's pent-up demand from the consumers as well. But it's not just the equity markets. We're seeing rallies in, like, if you take a look at global housing prices, for example, we're at a 40-year high. And it's not just the United States. You're seeing that sort of around the globe right now, the fastest rise in home prices in 40 years. So I think that these concerns on asset reflation and asset bubbles are not going to go away anytime soon. There are structural factors that are driving the inflows. Given how low yields are right now, given the strong earnings numbers that we've seen, and given the fact that our growth forecast still 5% global growth is still one of the better numbers that we've seen post recovery. So I think it's too early to talk about this being late cycle. But it's not too early to talk about the possibility of a policy mistake or a mistiming mistake. And I do think that, the bottlenecks that we've seen from the supply chain have put more of the focus on inflation. And whether we are going to continue to see higher than expected inflation, and also not just goods inflation and the supply chain, but also more services inflation. When we look at rent inflation, also the need for higher wages in certain sectors, given some of the labor shortages.
Right. So having fully valued equity in bonds right at the point when the Fed is starting to raise interest rates sounds like a toxic combination. How do you think about asset allocation at a time like this? Andrew?
So thank you very much for the invitation. It's so great to be here at the Megatrends Forum. Just a little bit about me first before we get to this question. I was born in Malaysia, Kuala Lumpur. My parents are from Taipei. I represent BlackRock Systematic, so we manage approximately $500 billion in actively in systematic strategies, approximately $250 billion in actively managed systematic strategies, and around $265 billion in various factor strategies around the world. So, Riz, thank you for that question. I want to say it's not just about strategic asset allocation, but I think we have to, going to Nadia and Joyce's comments, think very much about tactical asset allocation as well. And I think we could think in terms of tactics short-term, medium-term, and long-term. And we have to think about these different ways of return generation for our portfolios. Short-term, we kind of like consumer demand revivals, fintech, digital payments, green mobility, and we're short the dominance of internet retail, which did so well in 2020, and we're short crypto-exposed firms. What we do for this, and alternative data being a topic for the whole forum, is that we look at and identify themes with big data. These are things like financial news, broker baskets. We look at conference call information or text-based information, thematic flows, including the flows of various investor types. And then we use textual analysis with topic counts to identify these various themes. Then we finally construct a portfolio adjusting for correlations across themes, and we net holdings across those themes. Now, one of the things that I just mentioned was on emerging theme analysis, having us liking reopening winners. And that plays into medium-term trends of factors. In particular, we're barbelled right now, where we like value, but we also like growth. The value story is one from November 9th, I like to call that Pfizer Day because that was the first day that we saw news where there was an effective vaccine available. And value turned around and it did very, very well. But since May, we've seen market participants flock back to growth as concerns about Delta have been much more widespread. Now, what's really driving this is we can think of value firms as really being long physical capital, and the growth firms benefit from social distancing and benefit from a virtual world. And so as we started to reopen, it's no surprise that these value firms that benefit from physical proximity with lots of physical capital did extremely well. And since May to now, with some rebound over the last 2 weeks, though, we've seen growth really take off at the expense of value. I think this is a very attractive entry point for those investors that missed out on the rebound from value in 2020. We get a second chance right now. The path to reopening isn't straight, but it is inexorable. And Nadia mentioned that we go from pandemic to endemic. Global growth is still very strong, particularly in the developed markets in the United States where I live now. And our concentrated value offerings have been up 35 to 40% year to date. But at the same time, these concerns about Delta are widespread. I think one of the side benefits of this is that at least it gets people knowing a little bit more about the Greek alphabet. The last three letters of the Greek alphabet are Chi, Psi, and Omega. And if I think we reach those in the popular lexicon, then we are in terrible trouble across the world. We do have to be cautious, though, and that's about quality. Quality can capture opportunities in companies with solid underlying fundamentals. Those things like high profitability, high earnings consistency, and manageable debt. And those are all three metrics that we use in our quality strategy. It's not only us as systematic investors, but this view is endorsed by many fundamental investors as well. Quality stocks are trading at their cheapest level in 2 decades, as cheap as going to the early 2000s dot-com bubble. And in addition to quality being in favor given our current market conditions, well, it's been also one of the best performing factors this year. So let me hold off on the comments for the long-term trends, because Riz, I think you're going to mention some things about sustainability. And I think that is the greatest long-term trend probably of our lifetime.
Right. So you mentioned quality, you mentioned growth as factors. Now, Joyce, how do you view asset allocation? And please don't tell me to buy any more FANG, which just fits into this overbought kind of cycle.
Well, we have really done a lot of work looking at the 60-40 asset allocation formula. Over the last 4 decades, if you invested 60-40 U.S. equities bond split, you could earn about 10% over the last 40 to 50 years. Now, given where yields are right now in the developed bond world, and also our forecast that projected equity returns are going to be more in the order of about 5%. We're looking at 60-40 generating something like more like a 3.5% return rather than 10%. And I think the low yield world is going to be with us for years. So we have really thought about just the way in which you have to shift the asset allocation. If we take a look at the U.S. Aggregate fixed income index, it's set to earn only 1%. With just over 1% annual volatility. So what we've been recommending is taking more of a look at a hybrid asset allocation model and looking at fixed income that has more of an equity-like return. So that means looking at high yield bonds, some emerging markets bonds, also CLOs, CMBS, convertibles, mortgage REITs. And when we have been asked what to do in China right now, we are more cautious on the equity market given the regulatory tightening that I think will continue and also the slowdown. But we still like Chinese government local bonds, where the yield differential to developed markets, the stability of the currency, which I think will still remain in place, as well as the fact that allocations are very low, makes it quite attractive. And I think a lot of people have said, do you avoid China right now? I think one has to be, concerned that the regulatory tightening is not over. There's also probably more downside to the property developers. But over the longer term, I think that China has a long-term goal to develop its capital markets. It is one of the biggest markets, and we do think that the Chinese economy will match the size of the U.S. economy before the end of this decade. So I think that one still has to look at the longer term opportunities in China and the fact that the capital market there is still at an early stage in development, and that domestic investors will be coming in, and that foreign investors still have just really low single digit asset allocations to China. But we prefer to pay that through government bonds right now. So higher yielding fixed income. We continue to think that some of the U.S. exceptionalism that we've seen in the equity market might still continue, because there's still more stimulus that will be coming online in the U.S. in contrast to the rest of the world. And I think that is going to support earnings, and also keep the consumer demand still very much as a positive force next year.
Thanks. Now, Andrew, I understand that you're looking also at alternative data as a way to gauge where we are in the global cycle. You alluded to it earlier. But how high conviction are your insights on this, and how long before we start to see products based on alternative data from BlackRock?
Well, I think alternative data is no longer alternative, and it's no longer optional. It's absolutely essential. The thematic rotations that I talked about earlier, we're running those live, and we have been for some time. In fact, our research in this, we actually call a theme machine, coming up with themes that I talked about earlier. But one area that I think is really, really key, in fact, there are two key areas for alternative data. One is on China that Joyce and Nadia mentioned before. Let me talk a little bit about that. And I think the other one is for sustainability. And alternative data, I think, are absolutely essential in both. So first on China, there is a large amount of both numeric and text-based data in China. And there's a lot of high conviction alternative data. And Riz, to your question, some of these things that we have for satellite imagery, credit card, the things that we have for data from mobile app users, ad spending, job postings, and social networks. These are all extraordinarily valuable. In fact, many of the text-based data sets tend to have more predictive power than in the US. Just to give you an idea, there are 10,000 plus broker reports that we receive from China, 80,000 plus estimates, 20,000 plus estimates for financial news. All of this is extraordinarily valuable. And one area that China has, which the US and other developed markets do not, is that you can see intraday trading patterns, and the identities on some of these trades are actually very well known. Whereas in the United States, that sort of granular data is not available. Let me turn to the use of alternative data in sustainability. And here I think it really comes into its own. And let me just mention two types of signals that we have, one factor-based and one going beyond factors for alpha. One of the best signals this year, in fact, the best one in our systematic portfolios, is corporate culture. And I think if the pandemic has taught us anything, it's the importance of culture and the way that we live at home, and the way our society operates, and certainly the way that we work in teams, in companies. Corporate culture is absolutely essential. But culture tends to be qualitative and therefore hard to measure quantitatively. We can use alternative data to come up with a quantitative measure for this very important but elusive concept. So what we do is we use natural language processing. We actually borrow some research. It's an academic paper by Luigi Zingales. He's a very famous academic at Chicago. And we develop a word embedding algorithm. The way that this works is it's based on 5 pillars of corporate culture. And these are innovation, integrity, quality, respect, and teamwork. And we follow a word embedding approach. So what this does is you first seed these pillars, and then the algorithm learns words and develops a dictionary. So integrity, the algorithm learns, will be related to responsibility or transparency. And so we build a dictionary of words on a training sample that are related to corporate culture. We then apply count techniques for these words with appropriate adjustments for length and frequency and a couple of other things on conference call transcripts for these companies. And that allows us to come up with a quantitative score for corporate culture. It's a form of quality, which we then add to our traditional financial measures of quality to come up with an aggregate signal. Another example for the use of alternative data for sustainability is leads buildings. Now, leads buildings, if you happen to work in a leads building, certainly these buildings are very nice and they have reduced costs. Companies which have headquarters and they have plants in leads buildings tend to outperform. You have to identify these lead buildings. Actually, all of the 150,000 buildings across the world, they're listed publicly online. The trick, though, is that you have to map those buildings to a ticker, ultimately, that you can trade. And so that involves quite a bit of text manipulation, a knowledge graph, in fact, to map that alternative data back to the underlying companies. Now, we find that companies with leads buildings do better, but they also, these same companies, tend to have more efficient, productive firm outputs. I don't think it's actually just working in a leads building that it's leading to greater profitability. What I think is that these things are simultaneous, that if you have a company really concerned about efficiencies in their production line, then they're probably more likely to take that sort of attitude and approach across their entire way of doing business, including one manifestation being in a leads building. So alternative data is not alternative, it's as absolutely necessary to the way that we must invest across the world.
That's interesting. Coming back to this region, Nadia, is 2022 the year Malaysia's economy and more importantly the ringgit, the KLCI, is this the year that it comes back from deep slumber? You've gone through the recent Malaysia plan. Does the government really have the financial firepower to wake things up in the same way as it did in after the 98 Asian crisis and the 2008 GFC?
Interesting that you brought up the 2008 crisis in particular, because what's happened is that the direct stimulus that the government has dedicated to ameliorating or mitigating the impact of this current crisis was actually a lot less in percentage of GDP compared to the previous crisis. So in 2010, I think the direct stimulus that was committed to recovery and growth was actually around 10% of GDP, when with all the total stimulus packages put together, what we've got right now is about 6% of GDP. So I think what the government is trying to do really is to work within its relatively narrower fiscal space that it has now compared to the conditions that we had in 2008, 2010. Admittedly, in the previous global financial crisis, and also in some ways in 1998, we were partially saved, or we were pretty much saved, I think, by the commodity sector, which, it is recovering right now, and we're probably going to see recovery in particular oil and gas prices given pent-up demand, as Joyce mentioned previously, as well as recovery in other parts of the world and high rates of growth even in developed countries, as well as still stable growth and demand coming from China, but it's less so now. And I think a factor that the government still has to look towards is really and we've spoken about this for a long time, is really in broadening the tax base. Currently, whilst 40% of government revenue is still dependent on direct taxation, only 11% comes from income taxes. And I think moving forward, the government still really has to find a way in order to restructure its finances, not just on the expenditure side, but also on the revenue side as well.
Right.
So
that's yes or no? Maybe.
It's a deep maybe, but it's a very conditional yes, as long as they realize that, as we've been talking about and we'll be talking about in this Megatrends Forum, you need to know what the narrative really is moving forward. It's not really the old way of doing things anymore.
All right. So I'd like to move on to how sitting here in 2021, analyzing macro markets growth has really become so complex. During previous recession and recovery cycles, all you needed to do was really just follow the Fed, follow the stimulus. And if you sit here in Asia, you just follow China PMI. Today, there are all sorts of micro undercurrents which make the macros a lot more unpredictable. Top of everybody's minds right now, including us here in Khazanah, is really China, right? So in the space of 1 year, the domestic market environment, especially for tech, has moved from a Wild West free for all to a regulatory heavy echo chamber, right? If you put that against the context of Chinese growth, which is slowing down structurally, against the context of profit redistribution, and kind of a long-term A-share return of just 2% over 10 years, right? Pre-COVID. Should we be playing China at all, Joyce?
I think that, China is going to match the U.S. as far as the size of its economy. The capital markets are still in an early stage of development. So I do think you have to be in China. But I think you have to be careful as well. Common prosperity is a longer term development goal. And the desire is to strengthen social protection, to reduce inequality. And I think that very much the policies we're seeing, there's a view that the government has that the market outcomes alone are not going to achieve these goals. So if you're investing in China, you're not just taking on the economic risk, you're also taking on the policy risk. The focus has been on the new economy, but I think one of the key goals of the Communist Party is to increase the welfare of the middle class, where the disposable income still disproportionately goes to housing, transportation, education costs. And so I think that you're going to see regulation in those areas as well. So we have seen, and there's questions, will there be more taxes, like property taxes, more pressure from companies to increase wages. So I think there's a lot to watch there, but there's also no doubt that the China demand story and the consumer market there is one that all multinational companies, even if there's some hesitancy, they see the opportunity there. And they also see that as China is able to increase the disposable income, there's going to be growth in those capital markets and in the equity markets. Right now, I do think that Chinese government bonds are the best way to play the yield differential. I also think that there will be pressure in China to bring down bond yields even more because the increase to the debt burden since the pandemic has been enormous. We estimate that China has increased its debt burden by 27 percentage points since the start of this crisis. And I do think they're going to put in some more RRR cuts, as well, given where the slowdown is. So I think you have to be selective, but I think one has to also look at the longer term opportunity and the way that this market will develop over time. But right now you've got a number of things that the market will remain focused on with respect to the risk. All eyes are on Evergrande right now, where we think it will be more of a state guided workout to contain the downside risk. We don't see it as systemic to the banking sector or even the property development sector. But I mean, if you look at the, property development is about 15% of GDP. So, these pressures are not going to get addressed overnight. And I think that, we will continue to see just more questions about just what does the recovery look like last year. So we still have headline growth at 8.3% this year, but next year we have it going down to 5.2%. And over time, just given what the demographics are in China, we do think that China's growth will go down more to a 4.5% to 5%. That has real implications for emerging markets at large, just given the commodity outlook, the ties to the commodity sector, and just China's role role in the emerging market sector. So, I think that, I think we're going to continue to have just that, even though there are opportunities in China, there's just also going to be a lot of concern also about just what the medium-term outlook will also bring with respect to the growth numbers and how they will proceed with reform of the state-owned enterprises, as well as the common prosperity agenda.
Right. So China aside, decarbonization and ESG is really another issue which complicates decisions. We talk about it a lot in Malaysia, right? Without fully understanding the ramifications of the economy. Nadia, you look at Malaysia's economic structure, very much an old economy, a lot of high-risk ESG sectors like oil and gas, palm oil, foreign labor-intensive industry, carbon-intensive industry. And you keep on seeing governance risk being an issue in some high-profile companies in this country, right? So how do we, as a country, write off and reinvent large chunks of the economy to keep ESG investors happy? And can corporate Malaysia really cope with all of this realistically?
I think it really all boils down again to what kind of story does Malaysia want to tell itself, and what kind of story does Malaysia want to tell the world about itself. I think you saw some hopeful shoots of dedication towards more environmental sustainability and institutional sustainability in the recently released 12 Malaysia plans. But again, that plan remains very much a general policy direction that the government intends to take. It isn't quite fully fleshed out yet. So if we're going back to our narrative theme, it's more like a short plot line rather than a fully fleshed out story, as it were. I think for Malaysia, the key really is to get back to the basics. It's the 3 Rs. It's restructure, reform, and rebuild in terms of what kind of country do we want to be in the next 10, 40 years. So you're right in the sense that we do have these large old sectors of the economy where it is the old economy. It is very much not just commodities based, but also quite, a large component of it is really in the, I would say, lower value added services sector. So that the services sector itself comprises about 60% of the economy. A large chunk of that is lower value added services. On top of that, we've actually gone through a period of, I think, premature deindustrialization. I think, Alan is going to speak in the growth and development session. Will probably speak more about that. So, we've got all these issues that had already been apparent even before the pandemic arrived. And what the pandemic has done is really sort of widen these gaps and schisms. And now we need to realize that, there comes a point where there are enough alarm bells that need to be rung. And there's only so much that we can press the snooze button on those alarm bells. So in a sense, yes, there is a need to completely restructure parts of the economy in terms of shifting towards more sustainable practices. We need to think about how we write off again these large chunks of oil and gas assets, and how companies such as Petronas and Felda need to restructure their physical assets, but also their human capital assets, right? And that goes for the rest of the economy as well. How then do we move towards the new, more sustainable economy? I think what the 12 Malaysia plan has done is sort of brought us to a general direction in terms of going to net carbon zero in 2050, which some of us might think that's a bit too late given what's going on in terms of climate change right now. But it's a promising start, but it needs sustainability and resilience to push it through. So I think it all boils down to the will to craft this new narrative going forward. And it's not just Malaysia that's facing this. I don't know if anyone noticed, but in the beginning of the pandemic, in April 2020, the FT, the bulwark of capitalism, actually put out an editorial saying that we need a new social contract. So it's not just Malaysia, it's other countries in the world. It's the US, China is going through that as well. And Malaysia needs to get on that train.
Right. And Andrew, BlackRock has been at the forefront of ESG based asset management for a while now. From from a bottoms-up basis, we've always known governance matters to returns. You mentioned that earlier in your alternative data talk. But essentially, when it comes to the E and the S, right, how does that affect fund returns, right? Environmental and sustainability.
Yeah, I think that this trend here, in the spirit of the theme of this conference, the invention of tomorrow, I think sustainability investing today really is the invention of tomorrow. It will be important, I think, over the decades to come, as we saw in the 19th century with Britain and imperialism, the 20th century with the dissolution of empire, right? And the 21st century that we're living now with China, the rise of China, and it's the green economy. Nadia mentioned a specific date, 2050. And I think this is the most important of the E, S, and G, is to find a way to have the same level of carbon emissions as 1850 to 1900, before we had the real industrialization of the world, to get to the same level of carbon emission, net zero, by 2050. And that is really the only way that we can limit global warming to an average of 1.5 degrees. All the other scenarios range from terrible to catastrophic. Now, this cannot be done, as you point out, without looking at the S and the G. In fact, I think if we don't have the S and the G, then we will fail on the first one. We will fail on the E. But now the E, I think, actually happens to be at least feasible and straightforward, as the IPCC put out earlier this year. We can reduce carbon by 50% immediately and then 7% year on year. We do that in our portfolios today. We can do that without divesting from an individual sector. That's accordance with the EU task force expert group, the technical expert working group on sustainable finance. And we can make sure that we can tilt to companies with proper green and brown revenue requirements. We have signals along these lines, alpha signals, that look at green patents. We actually use that as a measure of value, because patents are a measure of intangible assets. Looking at these carbon emissions, it's a form of quality. Companies with lower carbon emissions tend to actually outperform. But it's the S and the G that are really crucial and interact with the E that we must also take account into our portfolios. So how can we approach the S and the G? So the first one is through regulation. And that, I think, Nadia and others can comment on far better than me. The second is to use it as an alpha signal. This is not only the tectonic opportunity that faces mankind, it's also the greatest opportunity to create forces of alpha for our portfolio. So let me just give you some of the S and the G signals that we have put into our systematic portfolios. Companies that tend to pay their employees with greater benefits. We have a benefit count signal. They tend to outperform. Companies where we look at managerial diversity, particularly of senior managers and the board, tend to also do quite well. Very interestingly, in the United States, companies that tend to prioritize and hire more veterans tend to do well. And I speak just as one case study for a veteran, a former captain in the British Army who is now on my team, has been a tremendous, diverse, and very talented hire. We also have greenwashing signals. We have an ESG controversy signal. So it turns out that companies actually have to do what they say. And we can actually measure the discrepancy between what they say and what they do. And that leads us then to a measure of greenwashing. Fiscal responsibility, I'll end there, especially with these debates that we had around macro across the world, and potentially the increasing tax rates, which are the flip side of increased stimulus in the United States. Companies that tend to do their duty and pay appropriate amounts of taxation, they also tend to outperform their peers that do more transfer pricing and shift revenues to lower tax jurisdictions around the world. S and the G are absolutely crucial. We cannot do the E without the S and the G. It requires all of us. It requires governments. But as investors, I believe this is one of the greatest opportunities ever for us to generate alpha.
Thank you, Andrew. So I'm advised by the KMF organizers that we should open the floor to questions. Can we have the first few questions? So talking about China, is the Evergrande crisis just a tip of the iceberg? Joyce, you highlighted this earlier. Your thoughts on this?
Yeah, so the first thing I would like to point out is that if you look at the total loans in the system, that the property developers are only 7% of the loans. And we've done things like look at the loan loss reserve by the banks. So if we look at the entirety of Evergrande's debt, it's about 1.2 trillion CNY, or about 41 basis points of total credits in China. The bank's loan loss reserve was 340 basis points of bank loans. So multiples and multiples higher than the total debt. So I don't think this is systemic, but I do think you're going to have more downside risk. The way I would really compare this is that, it's it's sort of like looking at a bank run, of a thinly capitalized and illiquid bank in a period of policy tightening. And so you've had excessive leverage, you've had failed diversification, but it's not a solvency problem if the assets can be sold and they have saleable assets. So we've seen some announcements come out about this. But the challenge is going to be how quickly the government and the PBOC can react. And they're also going to have to prioritize, paying the workers, paying those who invested in wealth management products. Banks are probably going to be asked to cover non-performing loans, and I think bondholders will take a hit here. So I think this is something that is going to continue to have some negative ramifications, but I don't think it's something systemic, and I do think it will be a state-guided workout.
So basically, the government has it in control.
I think the government has no choice but to take a role in this one. So I don't think it's systemic, but I still think there is more downside. And they have a very fine line to walk, because when you look at household assets, you still have that housing is about 60% of that. So they don't want to damage the overall market. It will have to be something that I think is state guided.
All right. Can we have the next question, please? BlackRock has initiated an investment fund in China recently. What are the key reasons behind investing in China despite the regulations? Andrew.
I think China is also not optional. And despite all of the current controversies, the uncertainty, we have to be invested in China. I think the question is not should we be, the question is how. And Joyce mentioned that I think having a diversified portfolio across China government bonds, but also all the other types of bonds in China, that is one way to further have some diversification other than just equity. Playing different strategies, my particular specialty is factors. And factors work in China just as they do everywhere else. In fact, some of these factor patterns are very interesting. Momentum, price momentum, works very well in developed markets, but carries a negative sign. But there are forms of momentum, like fundamental momentum, which work very well in China. A third area, I think, is on how we should do this, is that we have to be very disciplined. In fact, we should use moments of opportunistic repricing to actually resize appropriately toehold positions in China. It's, I think we have to have China in our portfolios. we have to think hard about the best way to implement that China exposure.
Thanks. So I guess this brings us to the end of the macro market session at the 2021 Khazanah Megatrends Forum. I'd like to thank my panelists, Joyce, Andrew, Nadia, and thank the audience as well for their questions. Right. Thank you.